Good morning. It's January 18th. Ron and I are here today to talk about, and I normally say several topics. We've only got two topics. Okay. I have a license agreement with Ron to utilize his materials. The agreement requires me to share this notice. I do have his written permission to utilize his products in this manner. This disclaimer protects us as well as you. The information that will be presented today is for educational and informational purposes only and is not advice. And you alone are responsible for how you evaluate and utilize the information that you learn today. Our agenda is to review the current version. Then we're going to look at the market, the new market forecast for 2025. And we've put together some new criteria for the prospect list, and we'll go over that. The current version is A. It was updated in September, and that involved making some changes to the chart data. If you're having any kinds of problems running visions, make sure you're on A and make sure that you've implemented the Windows 10 support notice. And here's the market forecast for 2025. Take it away, Ron.
Well, you got a slide there, but that's okay. 25 forecast. Okay, so we're updating the actual. I know last meeting we talked about what the settings should be. So let's go to the forecast here. And here's what we came up with after a lot of discussion, Tommy and I, for 2025. Interest rates flat, okay? And I think based on the latest, discussion from the Fed, I mean, people are saying that there may not even be, any interest, rate reductions going in the year. They've already pushed it out a ways. So the flat signal, I think, is probably a good setting. Even if they go down by a quarter or half a point during the year, I really consider that as flat. You have to have a big move, like maybe 2% total, to say it's up or down. Okay. So I think interest rates are probably going to stay where they are, very close for the whole year. Unemployment rate I have up, based on all the Doge information. There might be a lot of government employees that are going to raise the unemployment rate over time because there's going to be a cutback. And when that starts happening, a lot of those people that are working away from home, 90, what did they say? 90% don't come to work in the office, so they should just stay home. You won't get paid. So unemployment rate, say, is going to go up. Price of oil down, that is based on the plans for the administration to drill, basically use our energy for sale to Europe and other countries so that you can, maybe reduce the deficit somewhat, use those proceeds. GDP growth rate flat. I think once you get through that, the administration starts taking all these actions, maybe down the road we'll have some growth, but in the meantime, it's probably going to be pretty flat. US dollar stronger. It's the first year of the presidential term, and consumer sentiment flat. And we're on the Sedgwick chart, we're going from C to A to B. Next year, we're going from A to B. Remember, I shared that the Sedgwick chart last week or last month when we discussed what the settings might be. The Sedgwick chart says 2026 there's going to be a big turn down. So that's already, trying to anticipate that occurring. So this might be the, 25 going into 26. Could be flat and then down. So those are the settings. And with those settings, let's take a look at the forecast. You see 2024. What I do is I adjust the settings so that the forecast and the actual are pretty close. So, and so we start out the year here, and we're going to have about a 10 to 11% increase for the year based on those settings, which is, again, a very, very nice upturn. And thing I've noticed, there's not a lot of, I'll call variability in that line. It's pretty flat. So we'll see what happens in the actual. So the actual, if you go to the next chart, we've got a couple of weeks. It's right on top of the forecast. So right now we're we're in good shape. The market is following what I've suggested here, but over time this will go up and down. So 10 to 11%. This is the result of last year. We had a 25% increase, and so both 23 and 24, the S&P 500 was up more than 20% each year, which is amazing, really, when you think about it. Back to back 25%. The forecast I have for this, for 25 is 10 to 11. So you could end up getting, doing better. That's great. But my forecast doesn't suggest we're going to do, like this 25%. I'd rather be more conservative. Assume a 10 to 11, which is an up year. So you can see where, if we follow this path, it'll be a good year, and we should have good opportunities in a number of companies with options. So yeah, so this is the actual. You can see there in the first couple of weeks of January, the actual and the forecast are on top of each other, which is good. Here is the outlook. It kind of supports the forecast, saying the next couple of weeks, going into February, really into March, before we might have a upswing. Otherwise, it's going to be pretty flat there, right around that mark where it is right now, 59 something. So in the middle of March, we're back down to that level. So you can see last year what the actual, up and down. We were some big dips, but the trend was up. So you see that going into March, the trend is back up again. So get that 10, 11% a year, and you have to have some upside. So there we are with the forecast and the outlook. This is my market commentary. I don't know if you looked at it or not, but I published that at the beginning of the year. There is a PDF that you can get. If you look at Snapshot, you can get this PDF that gets the discussion and shows my forecast in detail for the indexes. You see the Dow, the NASDAQ, the S&P 500. I also put in there the price of oil, the Fed fund rate, and the unemployment rate. So you can see how I did last year. And when you look at the full table, you can see it, year after year. Have I been close? A lot of times I'm off, but I think I'm close and more times than off. So this is kind of my projection, the forecast there for 2025. So I said price of oil 65 to 90, Fed funds rate 3.75 to 5, and unemployment 4 to 5.5. So I got a range there, but if you look at what I said last year, I was in the range. Okay. It's kind of hard to pick the exact number, but a range gives you a way to say, okay, where do you think the market's going to be? In what range? So is it going way down, or is it moving up? And the forecasts with the range there suggests an upside. Any questions, discussion?
I would like you to give us your insights on what the VIX might be doing short term and how that may affect how we want to invest.
Okay. Can you bring up the VIX chart, Tommy?
Yeah, give me a second.
Let's take a look at that. I think you have it in the trade alert.
I was just going to bring up visions.
The reason I ask is sipping on my morning coffee and reading the local paper, there was an article in it that was saying that they were expecting, whatever prognosticator was writing the article was saying that they were predicting a lot of volatility.
What? Okay. Did they mention the VIX at all, or?
They did.
Okay.
You
They
still
did.
get a newspaper?
Hey, I am that old, yes.
Okay, so you can see the big the big spikes there in the middle of the year and one at the end in December. So uh, will we experience the same thing? I mean, it's possible. Look at the last 6 months of the year. Big down up to 21 something, and in December way up to 27. The overall average there, has not really moved up a lot, right, Tommy? I mean, getting to 20, it seems to kind of always turn around 2021 and go back down. Right, that's the 4-year chart, right?
That's a 2-year.
This is 2-year.
There's 4-year.
There's 4 years, okay. So so back there 3 years ago, you had a prolonged VIX that was pretty high. And that 4-month period in 2024, it only got up to what, 21, 22. So what would cause the VIX to be moving significantly? What are the factors, okay? The economy, is there, interest rates, Fed's not going to do anything. That's not going to drive the market. Unemployment, will trying to cut down the big budget for the government, will that have a more bigger impact, or is there something else in the environment? Price of oil, if that goes down, that benefits a lot of companies, a lot of product, a lot of inputs for products are based on oil. Price of gas goes down, people have more money to spend on other things. So what would cause the VIX to really oscillate like it has here in the last 6 months? I don't know, maybe people have an idea. Anybody want to take a stab at that? What's out there in the environment, in the economy, that would cause significant volatility? Another war?
I
don't know.
guess since
China going after Taiwan, that probably would be a significant, event, and that probably would cause a lot of volatility. The market would go crazy. People wouldn't know what to do. If we get into war with China, that would be a very difficult situation. How could we help fight a war way across the world? That's very difficult. And why would we put all of our battleships and stuff in to fight and keep Taiwan separate? I don't know. The Chinese are building a big navy, so they've got a pretty big, fleet. Hard to say.
the person that wrote the article that I was reading this morning, his theory was that in the short term, the flurry of expected executive orders from Trump will definitely drive the volatility up. I don't know if he'll be right.
Well, it's possible, but I think everybody knows what he's going to try to do. I mean, it's no surprise, right? I mean, the big surprise was buying Greenland.
I guess my follow-up to that then is in the short term, that presents more opportunities for us, doesn't it, as investors?
Absolutely, yeah. And I think short-term, weekly calls are a great opportunity, okay? And you want some volatility to generate premium. So little volatility is good because then premiums go up. Interest rates are not going to go up to add more to your return, because sometimes when interest rates are really high, that's built into the option premium. But the interest rates at what, 4%, 4.5%, if you get a CD or something for 6 months, you maybe can get 4.5%. It's kind of, it's pretty flat. That's not going to go to 6 or 10%. So, yeah, volatility is okay. It increases the option premium that you can get.
Yeah, I took the outlook chart and of course a drop in volatility would mean the market would be
Going up.
up. So, I mean, maybe that's just an anomaly, but of course it drops again here. So
Right. So,
if
but
it were
if
to
you go
drop
back
back,
in time, you got the same up and down, right? I mean,
yeah. Okay.
does anybody have an idea out there? What would cause a big spike in volatility? What event? I mean, now, the Middle East is maybe going to get settled down with the ceasefire agreement. So that, maybe not be a hot spot anymore. Iran, I think maybe you could say they are in check in the sense that Israel has taken out all of their air defense sites and so forth. So if they start, hurling more rockets, Israel could respond pretty well and, do a lot of damage. Surprised they haven't done some already, but you're trying to resolve the Hamas situation. So, but once that happens, then there should be more peace in the Middle East. The Abraham Accords and those countries should get together and, try to live with each other. Whether that'll happen with Iran or not, I don't know. North Korea, we have issues there, I guess. Little saber rattling there with him building more rockets and more bombs.
Yeah, but
Uh,
they're sending troops to Ukraine right now. So,
well, right, and for the
a
for the
destabilized
records,
Europe would obviously, I mean, that would be a major change in the VIX. Uh, if Europe continued to be destabilized, it's been stable for so long.
well, right, and the thing is, Trump has said he's going to try to get that war stopped. Now, Ukraine. I mean, the carrot is that, well, if you guys don't start negotiating, we're not going to send any more, war materials your way. I guess that's part of the issue that they have to realize. He's got to, taking a little bit different position. So that's a positive. It's not a negative for the market, in my mind. So, what are the negatives that could cause the market to really tank? I think China is maybe the the one that is unknown. Will they go after Taiwan? They know that Trump is going to respond if they do, but what does that do to the market if that happens? I think it affects our chip development or chip supply. Let's put it that way. If Taiwan is overtaken, Chinese then have control. A lot of output that the U.S. needs. I mean, all those, all that storage and all those computers comes from Taiwan. We're not, we're not able in the U.S. to replace it yet. It's, trying to build more factories, more fab for chips and memory, but it's not there. It takes a long time. Intel's building, a number of facilities, but they're not online. So the risk is that would be a factor that would really cut into the ability of the U.S. to like build automobiles. If there's a shortage of chips, what happens? So they can ship cars. It's happened to Ford, right? Some time back, they
We
they
saw
had,
it in 21.
had trucks, I mean, they had hundreds of trucks sitting on the lot. They couldn't sell them or move them because they were missing computer chips. And that's a Taiwan situation. So that's a sticky point. Or will there be a cyber attack? Will Iran, attack the U.S. in a cyber situation, shut down the energy grid or the electric grid, do something really bad? I don't know. We've got a lot of that going on all the time. Every day there are break-ins with cybersecurity. So That's an unknown, big unknown. TikTok.
Boy, there we go.
What's going to happen with TikTok? Is that going to affect the economy? A lot of the people that are using it are already moving to other platforms from China. I don't quite get it, but 100 million users? Wow. I'd like to sell an ad, not right to send that to everybody. 100 million users. So that's that's a big pile. We have to get, I don't know. That'll happen Monday, right? Once Trump
Yeah,
is installed, what is he going to do with TikTok? Is he going to issue an executive order? Because there are bids, I guess, on the table to buy it. Who's the Shark Tank guy? The money man?
Kevin O'Leary.
Yeah, Kevin O'Leary. Yeah, he's got a consortium. He's got a bid on the table to buy him. He's been working with Trump.
And there was rumors that Musk was interested in buying
Yeah,
it.
I know. Well, and then there are people saying they didn't want Musk to own it because he already has X, and said that you got one guy owning a lot of the access to the world people. I mean, to the eyeballs. He could control that. So I don't know.
I think it's got to be tied to energy because all of the AI products coming out take so much energy,
Oh, right.
so it's got to be tied to new sources. Old sources have to be used until we get new sources. Otherwise, what good is any of it? I mean, they hit our energy pockets.
Right. Yeah.
Then you don't have anything that
No backup. There's no backup. There is no nuclear plant you can turn on to get backup, right? Who is it? Is it Amazon that's buying that part of that nuclear facility
3 Mile Island.
to basically shore up their AI and their computer center requirement? So could be more of that going on, which is a positive. But if some of that was taken out, that would be a very severe situation. So I think we're more or less leaning to I don't know, an event, a unpredictable event causing something to happen. Whether it's the energy supply or the grid or something going on with China.
Well, a terrorist
Is that-
attack. If you were to see a terrorist attack in DC, take out
Part of the
part of the
government?
government, I that would obviously spike up the market tremendously, I think. So, I mean,
Yeah.
it could be as simple as you were saying, just a cybersecurity thing or take down the grid.
Right. So I think we're talking about some kind of hideous event that you can't predict. This is not price of oil or whatever. It is something, that you're really not prepared for. And
The oil in this region, and they do a lot of drilling in Utah. There's pretty well have stayed right in the $80 range. Pretty consistent.
right.
David, I guess we've overanalyzed your question.
There'll be some unexpected volatility we can't forecast.
Can't forecast it.
But
Can't write a
expect it to-
program. Can't write a program that's going to do that. Okay. Well, shall we get back to the
Yeah.
Work.
get back to work?
There we are
Yeah, we'll
again.
get back to work there,
Get back to work.
yeah.
All
Okay.
right, fundamentals refresh. So I start this off by going through what Ron says in his books. That's page 55 and Show Me the Money. And if you're like Bob Anderson and myself, you've got the Money Tree book. It's on page 26 there. Stocks with options, revenue, looking at 250 million, desirable 500, market cap 500 million to 750. Criteria being revenue growth being positive, desirable 5 to 10%, and earnings positive in 3 of the 4. And it's desirable that it be all 4 positive. Volume 250,000, desirable 500,000. And then bear cash, companies having bear cash. And as Ron points out in his first book, that really helped him avoid the .com crash that was taking place. So before we get into it, let's look at the fundamentals we're currently using. Obviously, we're looking at stocks with options. We've opted for the 500 million on the revenue and the larger on the market cap, 750. We lowered the revenue growth to -5%. We were staying with earnings. You could say 3 or 4 being positive, but we wanted to make sure that the last quarter was positive. A volume greater than 500,000. Bear cash, we were using a -5 billion, recognizing that some companies do operate well by taking on debt. And I always like to think of Caterpillar and John Deere as examples of companies that have debt that you would not necessarily say that's a hindrance to their operations. And then in addition to the criteria from the book, for the trade alert, we're focusing on stocks and ETFs that are less than $125 a share. We're using weekly options. Years ago, we had monthlies and a combination of monthlies and weeklies. At this point, we focus strictly on weeklies. As a personal preference, I eliminate the foreign companies, tobacco companies, the real estate investment trust. And then once we go through all those stocks, we add in ETFs. And currently the criteria, there were 35 that met that. So going into this first quarter of the year, as we go through, you're going to see that we made a couple of changes, nothing in the top 3, and we keep the revenue growth at -5, but we change earnings, and now we're tightening up earnings by going with all 4 of 4 needing to be positive. We think that companies should be hitting on all 4 cylinders at this time. We've gone through a period of low interest rates where we saw a lot of companies take on debt. We've seen where the interest rates have been ramped up. Now the Fed tends to say that the market's kind of stabilized. We've gone through the inflationary period. But at this point, companies ought to be pretty consistent in being able to hit their objectives for earnings. Keep volume the same. But now we've opened up the bear cash. And as I say, we've lowered the amount because we've gone from bear cash of 5 billion, -5 billion, to -25 billion. We see good companies that are maintaining debt load and have current operations that can support that. So we're looking larger at that. That's going to require us to do additional due diligence on companies. to make sure that the cash flow can support that, to make sure that their market cap and their revenue, annual revenue, is greater than the debt that they have, as opposed to being the other way around. Stock price stays the same, and we keep it with weeklies, and we've loosened it up a bit to where we do allow some foreign companies. We still exclude tobaccos and rents. We exclude any China company. So anything related to China as a country, we don't include that. So you're not going to find TikTok in our list, okay? And then we add in these weeklies. We include those. So let's look at the numbers. This is in the order that they are in Ron's book. So we start off U.S. stocks with options, 1805. The revenue per year, we ended up, as you can see, that lowered the candidate pool some. Market cap really didn't change it much. Sure, it eliminated some companies, but most are pretty much in that group. The revenue per growth trimmed the list down some. So that tells us that there's quite a few companies or as a part of this group that were not growing much at all. By going to all 4 of 4, you can see the impact of that, reducing it to 867. The volume doesn't change it a whole lot. And then the bear cash reduces it by 100, roughly 100, a little bit more than 10%. So then when we get to the stock price, that trims out a lot of the expensive stocks. You can see that impact. So once we get take that 551 stocks, we go out, we determine how many are weeklies. You can see that how much that impact is. And for comparison purposes, last quarter that we were doing this, when we got to this point in the list, it was 110 equities. Now it's 127. So we can see that the breadth of stocks being considered has grown a little bit, about 10%. And once we eliminate the foreign companies, and that's not total elimination, we still have some foreign companies in here. Most of them are in the energy field, technology field, and the medical fields. So those companies are on the list. And the mining, there's some mining companies up in Canada that we kept. Add in the ETFs, and the ETF, we had a few that have gotten more expensive than $125. And so that primarily cut back the ETF list. So the candidate list, 142, which isn't too far off from what we had as a pool last time, which was 140. So we're pretty consistent, I'd say, in terms of what the pool of candidates is. We're finding opportunities even with that list. Last time I did this, I said, what if we said you wanted to be exactly like Ron's books? Okay. So let's look at what the candidate pool would look like if you followed Ron's book criteria pretty stringently. Took the revenue at 500 million, kept the market cap at the larger end. That way we keep the top 3 just like we have on the trade alert. Ron says revenue growth has to be positive. Preferred was 5 to 10. So I said, okay, let's take 5%. So that cuts the list more than half, but still a pretty good list of companies that even have the 5% revenue growth per year. Ron's minimum was 3 out of 4 positive. Desirable was all 4. And since the trade alert is going to use all 4, I went with all 4 here. You can see the impact of that trimming down. Volume doesn't change it much at all, just like we saw in the trade alert list. And then the bare cash, Ron's criteria in the book is you got to have positive bare cash. So it's got to be greater than 0. And that cuts the list quite a bit. Stock price, less than 125. Now we're getting away from the book criteria, starting to look at the trade alert criteria. 212. You filter that for weeklies, major cutback. So when I look at this level, I say to myself, and I say to Ron, there's probably good companies that have monthly options that are out there. And so Ron and I are looking through that list, trying to determine, do we want to kind of go back to having some monthlies in the list, or do we want to create a second tier of the trade alert, which would focus on monthlies? I know Bob Anderson, for one, you talk a lot about trading monthlies. To me, this really supports what you're saying, and you've said for months, which is you find good companies that have monthly options, and there they are. So, so the weekly is really filtering us away from if you were to apply Ron's criteria directly. And then you eliminate the foreign companies, and it really doesn't change the list that much. And of course, then you just add in ETFs, that's ETFs. Okay. So with that, that's the end. And discussion.
So if you were just to do monthlies, then would you be looking at something that would give you a premium of 4%, or is there a criteria there for that?
Well, we haven't gotten to that kind of a stage. We're still at the front end of things by looking at the fundamentals. But yeah, 2 to 4% is kind of what you hear people say covered calls can do. Bob, you've done really well, as you've pointed out over the years, and I don't know what your performance level is, but I would imagine it's in that probably 3 to 5%.
Well, and I won't do a trade where I don't make at least 5%. That's one of my rules of thumb.
Okay.
There's enough stocks to work with, and I have a list. Well, I've been doing this forever. I have a list of, I've boiled it down to about 100 stocks that I have traded and continue to trade. And I do really well making money off of those stocks.
Yeah, and I would think at a 5% kind of a goal, David, it would be, you're taking on more risk by taking that longer exposure. So you're probably going to give up some downside protection. I don't know. Man, I don't know that you could really make the 5% and be in the money on some of those trades. I mean, maybe some.
You have to have some appreciation.
For what it's worth, I have stocks that I've owned for a long time that are not worth basically what I paid for them. Close, but not. I've got stocks that I have made anywhere from 50 to 60% on my money doing this with. So the way that I have chosen to trade has worked out well for me. And I think that's kind of what everybody has to do, is find out what fits their personality.
Right. Ron, you were fixing to say something.
Yes, I was just going to say that, if you look at the magic chart, it's trying to, if you go out in time, okay, you need to realize you're not going to get that 1% a week. Okay, that curve, falls off rather quickly. And the thing you got to be careful of is not to go out too far. Okay, like 6 months. Okay, buy a stock and then do a call 6 months out. I think you're going to leave a lot of money on the table, and there's so much stuff going on nowadays that you don't want to put that much risk into it. So you're better off taking a little bit less and shortening up the time. That's kind of why we've gone to weeklies, because the
Well-
weeklies are available and there's a big list that have weeklies. So it's been, we've done very well with that idea. There are maybe some good companies out there for monthlies. Part of it, their stock price might be higher than $125. So we found that. I mean, we drop out a lot of companies, well, a lot, maybe 30 or 40 that are trading higher than 125. If you'd included those in the list and said, okay, let's do a monthly, there probably are some good opportunities. You might have picked up AMD, or no, not AMD, NVIDIA in that process. You might have picked up Tesla in that process because their fundamentals are good. It's just that the stock price, has, put them, taken them off the list. So that is one variable that, we're trying to provide opportunities for people that don't have, multi-million-dollar accounts. That's the key to the whole thing. So, and stock price is one of those. It still gets you opportunities, but at least you're able to buy, 100 or 200 shares and do the trade and make good return. So, so there might be a way, or, where Tommy and I are talking about providing another set of trade alert opportunities that have a little bit different criteria to select the stock, like stock price.
I
Well,
have
yeah,
three.
And maybe monthlies.
I was going to say, and we've come up with some of that criteria. Number one, we would allow, a higher stock price, and we allow companies that had monthly options.
Right.
But part of what we're looking at that being, as I said last month, a live signal that goes out during the market day while the market's trading, and you'd have to do your own due diligence at that point. But we would show, companies that have good entry points, which is what we as covered call people are all looking for. What's a good entry point for an equity? And then does it have the right kinds of options and premiums that we're looking for? So I think that the largest problem to crack is, can you find those stocks with good entry points? Because all of us can then use visions to find those options. Does it meet those premiums that you're looking for? So a pre-filtered list that meets certain fundamentals, but you'd still have to do some of your own due diligence, because we're not looking at, like in the trade alert, we are saying these are companies that have good options.
And fundamentals.
And fundamentals.
Right. Right.
So what we're looking at is good fundamentals with good entry points. That's a shift. And so then you'd have to do your own due diligence.
Well, plus if you're going out monthlies, you're going to look at what is the return for that, 4 weeks out. But if you're halfway into cycle, it's only 2 weeks out. So you got to realize that, okay, in 2 weeks, I should get a certain percentage.
Well, and I have one stock that only has monthlies, but
Right. But there are a number of opportunities as we
I
discussed.
consistently make a buck off them.
Yeah.
And I have got 3 stocks that I have played with for years, and I call them my cash cows. they just make money. The one that I started trading in 2013 that I still trade on a regular basis, so far I've made about $22,000 off from it.
Is that SPRT?
And we're dealing with, and I'm only dealing with 100 shares. I don't do the volume of shares that you do on the weekly.
Yeah. Okay.
I call myself 100 share Bob.
One lot wonder.
Cheap is the word.
The one lot wonder. Okay. Nothing wrong with that.
Right. So if the market is going to have a good year in the sense of not really crashing unless there's some kind of significant event which we can't forecast, then the opportunities for 2025 are really good. Okay. So you can mitigate your risk with these weeklies. You can go in the money, get a nice return, 1% or more in a lot of cases, and have some downside protection. I mean, but if you had another list, you have some companies that are showing really great potential, have good fundamentals, and say this guy is going to double their stock price over 12 months. Well, how do you participate in that? Well, you could buy it, and you could sell calls a couple months out with an appreciation. There was out of the money calls. So while you're waiting for it to go up, you've at least got some return that you can bank and say, okay, if it gets to my strike price 2 months out, that I want a 10% appreciation. If it gets there, you made a good decision. If it doesn't, you might have made 2 or 3% on the option premium. So you're still holding it. And then you rewrite that call out again for a month or two. So it's finding those companies that might have that momentum. And what are the fundamentals that you need? Well, I think having positive revenue growth is one of the fundamentals that you need to have the stock price go up. Companies that are not growing their revenue, they're not expanding, they're cutting back. Their earnings might be okay because a lot of companies manipulate their earnings to make sure that the analysts follow them and say, yeah, they met their cents per share for the quarter, but did they grow the business? So finding those companies that are growing significantly, and that's just that variable. Revenue growth is a good fundamental. You can say, I want only those. I want to look at only those that are growing revenue 10% a year. So they're really expanding their market share and growing. Those are opportunities to do a longer term call and out of the money. So you're taking some risks saying it'll never get there. And that's why I say sell a call a couple of months out so that you're at least earning something. It may be flat for that period, but you've got some return. You're not waiting just for appreciation. You have to really have some home runs to make it just by appreciation.
Well, having done this long enough, we've got to see the market crash on more than one occasion. And you tend to survive the ordeal.
Yeah.
Yeah.
All right, then. Any other last minute questions? Thank you
I have
all.
a question.
Yes, sir.
It's like this week, this ACMR. I mean, sometimes I see it run away and I wonder, why don't I do the trade like you're doing and then buy some additional shares just to test the waters if I think it's going to be really good? Is that something that anybody does, or is that just gambling?
Well, the way I do it is with double up, right? Buy some and do a call and say, okay, there's more opportunity. I'll buy more of that company at a lower price. I'll sell a put.
That's how I do it. I don't
That
buy
way, if the
shares,
stock
I
goes
sell
up,
a
your
put.
put expires, you've made some extra return, okay, and you're happy. If the price goes down, you might buy some more at your put strike, but now you turn around and sell calls, okay? Because you made your decision the week before or 2 weeks before to enter the stock, to buy the stock, sell a call. So you're just kind of saying, okay, I can double up and maybe it'll hang in at the same price as my put expires. So that's where the fundamentals come into play. You want to make sure if that happens, you're in a company that's got, either good revenue growth or is very positive earnings and so forth. So it has some momentum so that it doesn't just, go down, 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 down every week. And one of the things that we look at, if you get the chart and you get a buy signal, look at where it says you should sell at, right? The sell on loss, sell on gain indicators are on that chart, you should write those down if you take a position. If you're going to do this, buy and hold, or for 4 weeks, document your entry price and then watch the chart as the sell on gain, sell on loss. It's the squeeze. They start going, to move together. The chart will get you, in other words, visions will get you out of the stock in 6 months. That's the squeeze. Once you got the buy signal, just keep track of the sell on gain, sell on loss. And at some point, you're going to have to make a decision. If it doesn't go all the way up to the sell on gain, you got to make a decision. When do I get out? Okay, I don't want to hold it forever. You can sell a call at kind of your exit point, right? If it gets to that exit point, then you're out. Okay, I'm saying sell it like a call, even in the money. You're getting the return in the money. If it keeps going down, you've basically recovered some of your loss. And so that's why I think it's important to understand the fundamentals are trying to make sure that you're not getting in a high risk asset. So they got to have some good fundamentals, carrying the company. That's why I like this .com era, the fundamentals, you would have violated a lot of the fundamental principles by buying into those companies that were just hyped up. Stock price was hyped up. They had no earnings and no revenue growth. So we're, pretty.
I do that quite often. I sell a put. So I guess I'm doing it right. I just didn't know it.
But this, you want a good underlying asset if you're going to sell a put.
Right.
Yep.
You might get a sign. It might go down, might go back up in 3 months, but you got to realize if you own it should have good fundamentals. It's like buying it and selling a call. You want to make sure the fundamentals are on your side. That's why even earnings data is important. Sometimes Tommy and I get, we pick out some nice candidates and says, whoops, the earnings date is next week. So no, we can't. We're not going to jump into that pool. Okay. Yeah. Wait till all that news is baked into the stock because it can affect it too much. The volatility up or down is too great. Why take the chance? Okay, wait for that news to get baked into the stock. If it's a good company, you'll have a good opportunity to do a covered call once the earnings are out. And the market will adjust the price based on that information. No need to take extra risk.
Thank you.
Yeah.
All right, then. Well, hope everybody has a great month. We'll be back in February.
Thank you, gentlemen.
All right, we'll be after Super Bowl, right? Yeah.
Yeah.
Go Chiefs!
No.
Maybe the Lions will make it once.
No.
While since they've been up there.
Commanders have got to win.
Who's going to win?
Commanders.
The Commanders. Okay.
They'll get a new stadium if they win, right?
Get a new stadium, huh? Yeah. Okay.
All right, everybody. Take care. Thanks again.
All right.
Thank you.
Bye-bye.
Bye-bye.